Cease overpaying property taxes, the senior tax relief programs your county never informed you about. If you own your residence and you are over the age of 60, I need you to halt what you are doing right now and grab your most recent property tax bill. Keep it right beside you for the next 12 minutes because there is a very strong possibility you are legally overpaying your property taxes by hundreds, sometimes thousands of dollars every single year. And nobody in any government office is ever going to pick up the telephone and inform you. Read that sentence again. The county does not call you when you turn 65. The tax assessor does not send you a congratulation notice. The forms that could save you $1,500 a year are sitting on a government website most seniors have never visited. And the deadlines pass quietly every January, every February, every April, while the savings vanish permanently into the county's general fund. This is not a glitch. This is not an oversight. This is how the system is designed to operate. And today, we are going to dismantle it piece by piece. By the time this video concludes, you are going to know the four major categories of senior property tax relief that exist in nearly every state in America. You are going to know the exact age and income thresholds that qualify you. You are going to know the three devastating mistakes that disqualify seniors who would otherwise receive every penny of relief they are entitled to. And you are going to have the complete step-by-step claiming process so you can act on this information before the next deadline quietly passes you by. Pull that tax bill a little closer. Let us begin. The silent retirement tax that nobody discusses here is the financial truth that most retirement planning content completely ignores. Property taxes are not based on what you paid for your home. They are not locked in at the number on your original purchase contract. They are not capped at the amount you budgeted when you first moved in. Property taxes are based on what your county assessor decides your home is worth right now, this year, using current market comparisons in your neighborhood. And over the last decade, home values across most of the United States have not just climbed, they have surged. The median home price in America has nearly doubled in many markets since 2015. That means property tax assessments have been climbing right alongside them, often at a rate that outpaces inflation, outpaces Social Security cost of living adjustments, and outpaces the fixed income that millions of retired Americans are living on. Think about what that actually means for a senior homeowner. You retired. You paid off the mortgage or got close to it. You did everything the financial advice columns told you to do. You planned carefully. And now, every single year, a bill arrives in your mailbox that is larger than last year's bill. And the year before that, and the year before that, you did not earn more money. Your house did not get larger. You did not add a swimming pool. The county simply decided your home is worth more, sent you the calculation, and told you to pay up by a deadline or face penalties. For a senior living on Social Security, a pension, and modest savings, this is one of the most damaging and least discussed financial pressures in retirement today. It does not make headlines. It does not generate viral outrage. It just quietly drains retirement accounts, forces early home sales, and pushes seniors out of neighborhoods they have lived in for 30 and 40 years. Here is the good news that the county is not promoting. Lawmakers in nearly every state have noticed this problem and built specific legal relief programs for older homeowners. These programs are real. They are funded. They are available right now. And the only reason most seniors never benefit from them is that the system requires you to find them yourself, apply for them yourself, and meet every deadline yourself, or you receive absolutely nothing. Let us fix that today. The four major types of senior property tax relief. Almost every homeowner over the age of 60 qualifies for at least one of these four programs. Many qualify for two or three simultaneously. Understanding each one is the foundation of everything else we are going to cover. Relief Type 1, the Senior Homestead Exemption. This is the most widely available form of senior property tax relief in the country, and it is the one most seniors have at least heard of, but never actually applied for. A homestead exemption reduces the taxable assessed value of your primary residence by a fixed dollar amount or a fixed percentage before the tax rate is applied. For senior homeowners, the exemption is specifically designed to be larger than the standard exemption available to younger homeowners. The state recognizes that older residents on fixed incomes need more protection. So, the senior tier of the exemption is built to deliver meaningful savings, not symbolic ones. Depending on your state, your county, and in some cases, your municipality, a senior homestead exemption can reduce your home's taxable value by anywhere from $5,000 on the low end to $50,000 or more in generous states. When you multiply that reduction by your local tax rate, the annual savings can reach hundreds or even thousands of dollars per year. Here is an example that makes the math concrete. If your home is assessed at $300,000 and your local property tax rate is 1.2%, your annual tax bill before any exemption is $3,600. Apply a $25,000 senior homestead exemption, and the taxable value drops to $275,000. Your new annual tax bill is $3,300. That is $300 in savings every single year just from one application filed one time. In states with higher exemptions or higher tax rates, the annual savings can reach $800, $1, and $200 or more. The age requirement varies by state. Most programs require you to be 65. Some begin at 62. A handful of states allow it as early as 60. Almost all programs require that the home be your main primary residence, meaning the place where you actually live, not a vacation property or rental. The application process in most states is a one-time event. Once approved, the exemption renews automatically every year for as long as you remain in the home and continue to meet the basic eligibility criteria. You file once, and the savings follow you for the rest of your life in that home. And Relief Type 2, the Senior Property Tax Freeze. If the Homestead exemption is the most common program, the Property Tax Freeze is the most powerful one that most seniors have genuinely never heard of. A tax freeze does exactly what the name suggests. It locks the assessed value of your home. At whatever level it was when you first qualified for the program, no matter how much your home's market value increases over the next 5 years, 10 years, or 20 years, your property tax bill continues to be calculated using that original frozen number. Let that sink in for a moment. If you qualify for a freeze this year when your home is assessed at $280,000 and your home's value climbs to $420,000 over the next 12 years because your neighborhood became desirable, you are still paying taxes on $280,000. The county does not get to reach into your retirement savings every year to collect its share of appreciation you never cashed out. States that offer some form of senior property tax freeze or assessment limitation include Illinois, New Jersey, Texas, Oklahoma, Tennessee, South Carolina, and several others. The specific mechanics vary by state. Some freeze the assessed value directly, others cap the annual percentage increase at a very low number, effectively achieving the same result over time. The income requirements for freeze programs are real and they matter. Most states set an annual income ceiling somewhere between $30,000 and $65,000, though the specific threshold depends entirely on your state and sometimes your county. Income calculations typically include Social Security benefits, pension distributions, IRA withdrawals, and other retirement income. Some states exclude certain medical expenses or disability payments from the calculation, which can help seniors who are closer to the income limit. The age requirement in most freeze states is 65, though some programs begin at 62 or 60. Here is why this program deserves your full attention, even if the annual savings sound modest at first. The freeze compounds over time in your favor in a way almost no financial product can match. If home values in your area continue rising at historical averages and your tax bill stays frozen while your neighbors watch theirs climb every year, the cumulative savings over a 15 or 20-year retirement can reach $30,000, $50,000 or more. This is not a hypothetical. This is the arithmetic of appreciation working for you instead of against you. Senior Relief. Type 3, the Property Tax Deferral Program. The deferral program is the least well-known of the 4 categories, and it is specifically designed for a situation that is extremely common among older American homeowners. You own a home that is worth a significant amount of money, but your monthly cash flow is limited. Your Social Security check arrives, your small pension arrives, and after groceries, utilities, insurance, and medical expenses, there is very little left. The property tax bill is not small, and paying it creates real financial stress. Even though technically on paper, you have substantial equity sitting in the walls around you. This is the house reality that millions of seniors live in. The deferral program is the government's acknowledgement that this situation exists and deserves a specific solution. A property tax deferral program allows qualifying senior homeowners to delay paying some or all of their property tax bill until the home is eventually sold or until the homeowner passes away. The unpaid taxes accumulate as a lien against the property, typically with a low state set interest rate that is far below what you would pay on a personal loan or a reverse mortgage. When the property changes hands, the accumulated balance is paid off from the sale proceeds. States offering property tax deferral programs include Oregon, Washington, Colorado, California, Massachusetts, and many others. The income limits for deferral programs tend to be more generous than freeze programs because the state is not forgoing the tax revenue permanently. It is simply adjusting the timing of collection. That flexibility allows the state to extend the benefit to seniors who earn slightly more but are still genuinely cash flow constrained. If you are a senior who has been considering a reverse mortgage or even a home sale simply to manage cash flow during retirement, investigate your state's deferral program before making any of those decisions. The deferral keeps you in your home, costs you far less in fees and interest than most alternative financing products, and preserves your equity while eliminating the immediate payment pressure. Relief. Type 4 the circuit breaker tax credit. The circuit breaker credit takes its name from the electrical device that shuts off power when a circuit becomes dangerously overloaded. The principle applied to property taxes works identically. When the tax burden becomes disproportionately heavy relative to your income, the credit activates and returns money to you. Specifically, a circuit breaker credit kicks in when your property tax bill exceeds a certain percentage of your total annual income. The exact trigger percentage varies by state, but the concept is consistent. If your taxes are consuming too large a share of what you bring in each year, you receive a refundable or non-refundable credit to bring the effective burden back into proportion. Many states offer circuit breaker programs with enhanced benefit levels specifically for seniors. Recognizing that fixed retirement income makes the overload threshold arrive much sooner for older homeowners than for working-age families. Some states extend the circuit breaker benefit to renters as well, operating on the reasonable assumption that landlords pass their property tax costs through to tenants in the form of higher monthly rent. The circuit breaker credit is typically claimed on your state income tax return rather than through a separate county application process. This means if you are eligible but have not been claiming it, you may have the ability to file amended state returns for prior years and recover credits you were entitled to but never received. Annual credit amounts range from a few hundred on the lower end to over $1,000 in more generous state programs. For a senior household that qualifies, this is a direct reduction in the amount of tax owed or a direct refund of tax already paid. Real money returned to your pocket every single year. The 3 mistakes that disqualify eligible seniors. Here is where many seniors lose benefits they have every legal right to receive. These 3 mistakes are extremely common and completely preventable once you understand what to watch for. First mistake 1, missing the application deadline. This is the most costly mistake and the most heartbreaking one to witness because it is entirely avoidable. Every senior property tax program in every state operates on a fixed annual deadline. Most of these deadlines fall somewhere between January and April, though some states have deadlines as late as June or September. The deadline is not a suggestion, it is not flexible. There are no extensions granted for seniors who learned about the program too late, forgot to file, or had a health issue during the application window. If you miss the deadline, you wait until next year. The savings you would have received for the current tax year are gone permanently. You cannot recapture them retroactively in most programs. You simply lost that money. The solution is simple but requires immediate action. The moment you finish watching this video and identify which programs you are eligible for in your state, write the application deadline on a physical calendar. Set a digital reminder on your phone and tell a family member so there is a second person tracking it. Give yourself a buffer of at least 3 weeks before the actual deadline to gather documents and complete the application. One date on a calendar, that is the entire difference between receiving the benefit and losing it. Second mistake 2, failing to report changes in ownership or marital status. This mistake catches seniors completely off guard because it feels counterintuitive. You have already been approved. The exemption is on your account. The savings are appearing on your annual tax bill. Everything seems automatic. Then something changes. Your spouse passes away, and the property title transitions into your name alone. Or you add a son or daughter to the deed as part of an estate planning strategy, or the property is retitled following a refinance. These events, which feel like private family or financial matters, can quietly and automatically cancel your senior property tax exemption without any notice from the county. Many states require the senior exemption to be held in the name of the qualifying individual. When the ownership record changes, the county system may drop the exemption from the account. The next tax bill arrives without the exemption applied, often months after the ownership change, and the difference can be hundreds of dollars that you were not expecting to owe. If anything has changed about who appears on the title to your home in the last 2 years, call your county assessor's office this week. Ask them to confirm that your senior exemption is still active and properly recorded on your account. This phone call takes 10 minutes and can catch a problem before it costs you money. Third mistake three, ignoring the annual income verification requirement. Freeze programs, deferral programs, and many enhanced exemption programs require you to confirm your income eligibility every year. The county sends a verification form. You complete it, attach any required documentation, such as a Social Security benefit statement or a copy of your tax return, and return it by a specified date. The problem is that these forms frequently arrive in envelopes that look completely generic. No bold warning on the outside, no urgent language, nothing that signals this piece of mail is standing between you and $1,000 in annual property tax savings. Many seniors mistake them for routine informational mailings and set them aside. The deadline passes. The benefit is suspended. Establish a firm rule starting today. Every piece of mail that arrives from your county tax assessor's office, your county revenue department, or your state department of taxation gets opened immediately on the day it arrives. Not tomorrow, not after the weekend, the same day. If it is a verification form with a deadline, complete it within 48 hours and return it with tracking confirmation. This habit applied consistently protects every benefit you have already earned from disappearing silently in the mail. Your step-by-step action plan to claim what you are owed. Knowing the programs exist is half the battle. Here is the exact process to move from awareness to approved benefits. Step 1. Identify the specific programs available in your state. Go to your state's Department of Revenue website or Department of Taxation website. Use the search function and type the phrase Senior Property Tax Exemption or Senior Homestead Exemption followed by your state's name. Every state maintains a dedicated page describing available programs, eligibility requirements, income thresholds, and application deadlines. If you have difficulty navigating the website, call your county assessor's office directly. Give them your age and ask them to tell you every senior property tax program you might qualify for in your county. Ask them to mail you the application forms. Write down the name of every program they mention and every deadline they provide. Step 2. Gather your documents before you need them. Nearly every senior property tax program will require the same basic set of documents. Gather them all into one folder right now so the application process does not stall on missing paperwork. You will need proof of age, which is your driver's license, state ID, or birth certificate. You will need proof of primary residency, which is your current property tax bill, or a utility bill in your name at the property address. You will need proof of income, which is your most recent federal tax return, your Social Security benefit verification letter, your pension award letter, or any combination of documents that shows your total annual income. You will need proof of ownership, which is your recorded deed, or a current mortgage statement showing your name on the property. Having these documents ready before you sit down to apply means the entire process can be completed in a single session rather than stretched over multiple weeks. Step 3. Apply formally and keep a complete paper trail. Most county assessor offices accept applications by mail, in person at the county government offices, or through an online portal. Whichever method you choose, keep documentation of the submission. If you apply by mail, send the application via certified mail with return receipt, so you have a legal record of the delivery date. If you apply online, take a screenshot of the confirmation screen and save the confirmation number. If you apply in person, ask the clerk to stamp your copy of the application with the date received. If your application is denied, you have the right to appeal that decision. The appeal process requires you to demonstrate that you meet the eligibility criteria. Your documentation and your submission records are what make appeals successful. Step 4. Build a recurring annual reminder into your calendar system. Set a reminder on the same date every year, approximately 45 days before your application or renewal deadline. Label it clearly. Something direct like property tax, senior exemption renewal. Check county mail. Submit income verification. This one annual reminder set today and repeated every year protects every dollar of relief you qualify for from slipping away due to a missed form or a forgotten deadline. The bottom line on your property tax bill. Property taxes are one of the very few expenses in retirement that increase automatically and continuously, regardless of how carefully you manage everything else. You can pay off the mortgage, you can reduce your lifestyle expenses, you can drive the same car for 15 years. And that property tax bill still arrives every year, larger than before, demanding payment by a hard deadline with penalties for late payment. The senior relief programs described in this video exist specifically because lawmakers recognize that fixed income retirees cannot indefinitely absorb unlimited assessment increases on homes they have owned for decades. The programs are funded, the savings are real, but the design of the system places the entire burden of discovery, application, and compliance on the individual homeowner. Seniors who go looking receive the benefits. Seniors who wait for the county to reach out never hear from anyone. You now know where to look. You know what to ask for. You know the mistakes to avoid and the deadlines to protect. The next move is yours, and the best time to make it is today, not next month, not after the holidays, not when things slow down. Share this video with one senior homeowner in your life. Your neighbor who has lived in the same house for 35 years. Your sibling who keeps saying they will look into it someday. Your friend who is quietly stressed about the tax bill that arrived last month. One conversation started by sharing this video could put real money back in someone's hands every single year for the rest of their retirement. Take care of yourself. Take care of your money. And take action on this today before another deadline passes without your name on the application.